thanks for tuning into this very special conversation on Talking Point as we made a norm. We talked to the think tank of CITI Research on what their verdict about the quarterly numbers are, and no different this time as we welcome in the team Surendra Goyal, Head of India Research at CITI, and of course tracks technology amongst other things very closely. Raashi Chopra, Director of India Metals and Cement. Kunal Shah, Director of India Banks and Financials, and Saurabh Handa, Director, India Oil and Gas and Telecom. All of you, rather, thank you so much for joining in. Great seeing all of you. Raashi, good seeing you after a while. But Surendra, is this earnings season, we know it's been a weak earnings season. Was it as bad as you anticipated, or was it worse?
Yeah, so a few things there. Okay, so like when we put out this note midway through, what we had highlighted is while the reported numbers at aggregate level were below expectations, but if you took out oil marketing companies, for example, then the numbers were broadly in line to slightly better. So I think it's been a quarter like that where certain segments of the market have pulled down overall earnings. Having said that, I think where we have been getting the most number of investor questions, and this is like particularly what people's expectations were going into the quarter in context of that. One has been consumption, because across staples, discretionary numbers have generally been weak. So what has suddenly happened on the urban side? Why is there so much weakness? That's one of the most common questions through the last 15-20 days. And secondly, asset quality increasingly is becoming a topic of discussion. Although the large banks, most of them had numbers pretty decent, but there are certain companies, and Kunal is here, he can talk more about it, where we did see some weakness. So those are the two most common discussion points. At an aggregate level, the numbers are a little weak, but that's again being pulled down by certain parts of the market.
Okay, so two questions rolled into one. I'll talk about financials and the asset quality with Kunal, but two questions rolled into one. One, do you see a pickup of, yes, we'll probably see a pickup in quarter three. Is it going to be a large pickup in the second half, or is it difficult to call that right now? And part two, what is ailing this weakness in consumption? What is ailing this consumption bucket?
Yeah, so we should see some pickup. We are not really expecting a large pickup. So even entering the year, our numbers were below consensus for Nifty, which we publish regularly. And through the last, say, 7-8 months, we have been 2-3% below consensus. So to that extent, we were always a little more cautious. And even now, it doesn't look like a big recovery when you look at all the drivers that you are thinking about from an earnings perspective. So overall, we think that from at a Nifty level, the earnings growth for this year is more mid to high single digits. Okay, and that's what the team is predicting bottom up for the Nifty companies. On consumption, I think rural, while it's improving, okay, gradually, the surprise really came on the urban side. And again, there are obviously multiple reasons, but one of the most common reasons which a few companies kind of discussed on their earnings call is that the metros have actually done worse, and possibly because some of the things that impact the urban mass consumer there, from an inflation perspective, the impact is a lot more than what the headline inflation would suggest. So I think it's the impact of inflation which has kind of impacted urban consumption more, and that is where we saw a very sharp slowdown. In fact, if you look at commentaries of most of these companies, rural is steady to improving, while urban is where the deceleration happened. So I think that is where the surprise came. And discretionary has been weak for a while. So we really did not see any change in trend there, because jewelry has been doing well, jewelry continued to do well. Some of very few players driven by market share gains have been doing well. They continue to do well. Rest of the discretionary space has been tough for a while now.
Okay, quick 30-second answer though. Is this inflation impact transitory? What's your sense? Does it kind of show up in quarter three again? Or?
So I think you'll have to keep a few things in mind. It's obviously there is an inflation impact, and like we'll really need to see, very difficult to say it's transitory or not. But I think what is also important to keep in mind is last year, same quarter, the base number for urban was also decent. Okay, so that also from a YOY perspective would have played on the numbers. So I think that should gradually ease as we go into next year. Okay, from a impact perspective, it's always difficult to call how transitory it is.
Okay. Well, I want to talk about tech as well, but so many other things to talk about. The asset quality on banks, metals, there's a recent development over the weekend, as also in oil and gas. So much to talk about. Kunal, I'll go in this order. He spoke about how the asset quality question has become the key talking point, and we can understand why. 2 or 3 banks doing so well, the rest not so. So what's your sense of that, and will it have a further impact on how the stocks behave as well?
So definitely asset quality has taken the center stage, and if we look at it in terms of the product segments, it has been more so with respect to the unsecured lending, and within unsecured it has been towards the microfinance and credit card in particular. So wherever the exposure has been higher to these 2 segments, we have seen banks reporting higher asset quality stress. In terms of the impact, I think given that the flow into SMA buckets in these 2 product segments have been higher, there could be a spillover effect in Q3 as well. And most of the management have already indicated that you should not expect maybe it to subside very soon. Maybe second half could be better, but that will be more in 4Q rather than 3Q. So in terms of the stock price reaction, obviously, since there is a spillover into Q3, into the next quarter, I think there is pressure on the stocks which are exposed highly to these 2 particular segments.
Okay. So in which case, I mean, I was trying to think of banks which actually did reasonably okay on asset quality. ICICI Bank, of course, stood out. You could argue HDFC Bank kind of mixed, but maybe slightly better than what a lot of other people anticipated. Does the market now again start rewarding some of the asset quality performing banks a lot more than some of the others? Is that your pecking order as well?
Definitely. So now the entire verbatim is also shift away from growth and margins towards asset quality. Till now, people were looking at in terms of how the growth behaves. And as you mentioned, like one of the bank was really lagging in terms of the growth, but it is standing out in terms of asset quality and seems to be outperforming as well in last 2 to 3 odd months. So given maybe now growth and margins being largely factored into the estimates, to that extent now it's like more the focus has been on the asset quality. And that's the reason the players who are doing relatively better on the asset quality side and who have outperformed, I think particularly with respect to the slippage and the credit cost and outlook also seems to be better. They should maybe they should outperform, and that's what our peak has been. So we have ICICI and HDFC as a part of our top picks.
As your top ideas. Okay. Lots more to talk about. I would love to talk about the NBFC space as well. But Raashi, good talking to you after a while. Thanks for joining in. And would love to understand, I mean, I don't envy your job. China just keeps you very, very busy, I'm sure, as also over the weekend. Yeah. So can I start off with the non-earnings part first? What do you think of the move that has been done? Because most of China's bazookas are looking like water pistols at the end of it. Is this slightly different in that and sustaining, if you will, this rebate tax?
So the, our global team doesn't think so, in the sense that, their view is that obviously this gives you that sort of, there's going to be an LME upside on account of this whole withdrawal. But again, the focus goes back to what Trump does. So it's basically a contradiction. If you look at, maybe our sort of views 2 months back, right? We had like a sort of a neutralish to bullish view on aluminium, zinc more neutralish. And now when you actually read, like our commentary from our team, the general thought process is everything is very uncertain. Whatever Trump is going to do and how China reacts to it and when China and whether China reacts to it becomes the big question mark. So it's literally more to be sort of neutralish on the space at this point in time than actually being, sort of invested in it. On
actual commodities, you mean, right?
Commodities, yes.
So therefore, the derivative of that would be, what's your view on the Indian commodity stocks? Back on results and back on the back of this piece that you just spoke about.
So we've been negative, particularly on the steel space. And, on the non-ferrous space, we have a buy on Vedanta for company-specific reasons, which I'll just talk about. On the steel space, what we've been highlighting is that number one, like you said, the China stimulus has been disappointing on a continuous basis, right? Property starts are down more than 20%, China demand is down more than 5-6%. So it's very hard to figure out what is really going to kind of change the game for steel in China, and therefore, as a derivative, what happens to India. And the Indian equities, like the Indian steel equities are literally like at 2.5 times the Chinese valuations. which, one can argue that India is a growing market, but at the end of the day, we're not isolated or insulated from the Chinese exports, right?
But we are growing capacities, right?
We're growing, so I was just going to come to that in a second. So I'm saying that the first point is that on the, China is always going to export, or China, Japan, Korea, they all export into India, right? So at any point in time, we're always going to be compared to the import parity price. So therefore, that growth, there may be a little bit of a growth angle, but you can't, I'm not sure if 2 times, 2x, like 10 times, 11 times EV EBITDA multiples are kind of warranted in that sense. So that's like the nearer term view, that even if there's a surprise stimulus, right, I don't know how that swings the Indian equities. Second, to your point, that capacity is getting added, which while it adds to the growth angle on the positive side, on the scary side, it is on the flat product side, demand will have to grow at about 10% to absorb that supply in the next 2-3 years. And that's not something that we've seen in the last few years. So then what will happen is, if that doesn't happen, then the Indian companies will actually have to start exporting out, which is not the most lucrative option for them. So whichever way we look at it, it's getting a little bit difficult to get positive on the steel equities. On the non-ferrous side, like I was mentioning, like general view is to kind of stay away from the commodities at this point in time. But the Vedanta buy is more company specific. They have a whole restructuring coming. They will deleverage well. There is a good dividend yield story. So that's the only one we're kind of supportive of at this point in time.
So it's a sum of parts story that you're playing because of a demerger or there's
whole restructuring that's going to happen, and they've done a really good job at deleveraging at the parent level. And then there's a good dividend yield story that kind of comes through it. So unless there's a massive collapse in the commodity prices, that of course will, that'll go wrong for Vedanta, but other than that, that's fine.
Okay, I'd love to talk about cement as well in a moment, but Saurabh, bring you in. First on the here and now, which is the news. This administered gas price allocation gashes that are happening, and it's almost coming without any forewarning, if you will. What kind of an earnings impact? More importantly, what kind of a multiple impact does a move or a set of moves like this have on the CGDs?
Right. So, see, it's fairly obvious that it could impact the margins and the earnings for these companies. The extent will obviously depend on how much they can pass through in terms of CNG price hikes. So we do expect there will be some price hikes happening. We haven't seen any since the last cut that happened in October. So we think it's a matter of time. So I think the near-term impact is sort of fairly obvious. It's kind of reflected in the way the stocks have reacted. I would probably just take a step back and try to look at things from a slightly medium to longer term perspective. The one thing that this could do is lead to consolidation in the sector. So clearly some of the listed players are well entrenched. So even though their margins could take a hit, but these are still strong companies with cash-rich balance sheets. Whereas some of the newer players could potentially face bigger challenges. And then we could potentially see an acceleration of consolidation where these guys could then use their cash for geographical opportunities. So that's one thing I think definitely worth looking at. The second is, so far the government's stance on pursuing usage of gas and pushing its use in the economy hasn't really changed. So a lot of senior government officials, the oil minister, etc., constantly make statements that they are very supportive of pushing the use of natural gas in the economy. And that in some ways then potentially could lead to, again, these companies benefiting from a longer term perspective. There is a constant talk of bringing gas under GST. If this happens over the next 1 to 2 years, then again, these companies could be better placed. So we think beyond the here and the now, if one takes a slightly medium term perspective, then the stocks have potentially come down to reasonable valuations where for long-term investors, they could be worth looking at. How much of a structural derating could happen? Part of it has already happened. Stocks like IGL used to trade at 20, 25 times. They were at 13 times right now ahead of today's correction. So
20% fall as we speak.
Yeah, so a lot of that derating has already happened. So the key to ask is after this 20% fall, what next?
Okay.
So I think in the near term, obviously we have to wait for the dust to settle, see what happens on, on things like price hikes, etc. But yeah, that's how we are looking at things.
So Saurabh, would it be fair to say that you assume that maybe there could be now, if there is to be a correction, it could be a time correction, not as much as severe price correction, because both valuations and the prices have compressed quite significantly in the recent times?
Potentially. So now we obviously need to see what further news flow can happen. I mean, is this like a monthly thing? Can there be another cut happening next month? But the other things are still very positive. The volume growth is phenomenal. You've probably read a lot about how OEMs are pushing CNG in their portfolio, right? CNG sales were very strong in the month of October compared to, say, the overall category. And the other thing is longer-term investors whom we've often spoken with, the one pushback we've always got on these stocks is, but they rely so much on subsidized gas. What happens if that goes away? Now, you know, it's almost come to that situation. So can this prompt some of those guys who were on the sidelines to then, you know, re-enter? So I think these are some of the questions we'll need to address. But yes, for now, potentially, we need to wait for the dust to settle in the short term at least.
But a time correction, not necessarily too severe a price correction here. That would be a
Yes.
summation. Okay, I'd love to talk about OMCs as well, because I've read your note on that, and one wonders, despite the crude price fall, why is it the stocks haven't performed? So I'll come to that in a moment. But the other big boy, I mean, aside of banks, of course, and information technology, the views spread right down the middle out there, Surendra. Some people are very constructive, some people are not, and the bulls say that now the big event that we were waiting for, which is the election, is out of the way. There will be clarity, people will invest, and orders will come in. What's your sense?
Yeah.
I believe you've been negative thus far.
Yes. So that's right. We have been cautious on the space. And
Cautious.
I don't think it's one thing which has been impacting IT spending. Okay, so like investors used to say that it's all about rate cuts. Then the rate cuts started, growth did not recover, people started arguing it's because of US elections. So it's a bit of a moving target. And our view is that it's not one event driven IT spending. If you look at some of the issues which Indian IT has been facing, firstly, from a share gain perspective, the pace of share gain has slowed down. Okay, and it's not because of anything that they are doing wrong. The penetration across segments of the market has gone up materially. The second thing is the whole global capability center debate. We believe that it does kind of chip away a little bit of share at the margin. And thirdly, from a spending perspective globally, it just pivoted towards Gen AI. Okay, and at this stage, Gen AI spending is more in other areas. So there are multiple things which are impacting spending beside the macro. Now, if you think about what has happened in the last 1 month, right, the US 10-year is up 80, 90 basis points, right? And people were very bullish on rate cuts. Now nobody is talking about it. So we still think that there are it's going to be very mixed. And that's the reason we are forecasting a very modest recovery, but slow recovery. So what we have been writing in our notes, it's bottomed out. It bottomed out in the March-June quarter itself. But it's a very slow recovery, and that is where the numbers just keep on disappointing. Because the market goes ahead of itself, people are forecasting a swift recovery, and then the numbers don't come out. Even in this quarter, like the numbers across the board, like a couple of companies, smaller companies might be taking share. But at a broader sector level, the numbers were still on the weaker side for a lot of players. And more importantly, the deal flow numbers were pretty weak across almost all the companies. So I don't think there is enough visibility to really come out and say that there is a big recovery coming. It still feels like a very modest recovery. And one has to keep in mind that the stocks are also trading at pretty much 15-year high value, or very close to 15-year high valuations, right? Barring that post-COVID period. Right now, the sector is 30, 31 times. The peak was 31, 32 times. Otherwise, these stocks have not traded at these levels, at least in the last 15 years.
Right.
So when you put it, this entire thing in the mix, I don't think it's that easy to be positive on the sector.
Okay, but you are selective. So you're very bottom up. I believe you're mid-size. If I'm not wrong, Coforge, I may be wrong here.
Yeah.
But those are a few names that you're...
See, I think the challenge that we are facing is that some of the stocks which are doing well are very richly priced also, right? So 40, 50 times earnings is the multiple which is already there on those stocks. So what we are taking is we are taking a view based on the growth outlook as well as where the valuations stack up. So that's a relative view. So within the sector, Infosys and HCL Tech are the names that we like on a relative basis compared to the others. But overall, I would still say that we are quite cautious to negative on the sector.
Okay, thanks for that. Thanks for that view. Raashi, I'd love to come to you on cement very quickly. A quarter which teaches you stuff at best, because otherwise it seemed a really forgetful quarter. Though, my question though is also two-part, very quickly here. Some of the southern exposed companies, because of the infra spend happening there, could they benefit even if the sector at large doesn't?
I wouldn't isolate them in entirety, because one is that, obviously it's an oversupplied market, right? The second is that you've seen a lot of this M&A happening in the southern market as well, where capacity utilizations are not necessarily at rated levels or high levels, right? So what's happening is, and I think that sort of works, or this narrative works for the entire region, all the regions in the country, is that because either the larger players are adding capacity or they're doing M&A, particularly in the south, they will want to make sure that the material gets absorbed, right? So even if there is some sort of benefit on the demand growth side, I don't necessarily think it translates into price growth immediately. So.
Okay. So avoid per se. No need to go out and buy.
No, we don't. On cement, actually, our view is that despite having a sort of a negative or sort of a muted view on pricing, we actually have buys on quite a few of the stocks, and the thought process is that, focus on stocks that offer growth and those that offer some cost benefit.
So which are these?
Because of the, just one more second, just on the cost side, it's not necessary that they will have to pass on the cost benefit if demand growth is adequate enough to keep utilization levels where they are. So that's the thesis over here, because one can always question that if they're getting cost benefit, why don't they have to cut prices further? So the thought there is that demand is not going to completely collapse, and so utilization should be all right. We have buys on Ultratech, we have buys on ACC, Grasim, Shree, and we upgraded Ramco very recently with the results. South-based player again, but that was again, the thesis was not so much on pricing, it was more to do with how well they've managed their cost structures, in a muted demand environment and pricing environment. So.
Noted. Thanks for that. Okay, last two questions, out of time completely, but Saurabh, can't not talk about OMCs. So first to you and then I'll wrap with Kunal. But oil marketing companies, despite crude prices behaving very well, we haven't seen the stocks perform. I mean, at some point of time, the earnings have to come up because we haven't seen price action or cuts out there as well from the government side. So why is it that the sector is not performing?
So the first reason, obviously, 2Q earnings were quite bad. And in fact, following those 2Q earnings, the point we were trying to make was some of the factors are non-recurring. And you should see a pretty significant pickup in earnings in Q3 and Q4. So you had these one-off inventory losses, which are unlikely to sustain. You've seen a slight pickup in refining margins. There has been this sort of constant overhang that there'll be a fuel price cut coming ahead of some state elections. That hasn't happened. So our view is that there is no immediate need, at least for a very sharp fuel price cut, which means, therefore, that these companies may be able to make slightly above normative marketing margins in the short term, say in Q3. So we are quite positive. In fact, we have put out a catalyst watch on HPCL as well. Basically saying that there should be an earnings rebound happening. And the last thing is on LPG, these companies have been reporting under recoveries, which they are having to route through the P&L, which is optically making earnings look a bit lower. And as and when the government announces some sort of a subsidy, which they usually do for LPG, given it's a controlled product, that can also optically boost your earnings. So we are positive. Maybe the market is waiting for this one sort of good quarter to play out and then start rewarding these companies, because on a dividend yield basis, they start looking very attractive.
Okay. Kunal, final question. In banks, one draw, the non-banking names, what has stood out for you in this quarter and the commentary?
So when we look at it at NBFCs, in fact, as I mentioned, in banks, it was purely asset quality compared to that of growth and margins. In NBFCs, we need to monitor all three levers, growth, margins, as well as asset quality. We saw RBI sounding slightly uncomfortable with exponential growth in some of the even secured lenders. Plus, margin trajectory would depend in terms of the rate action. And asset quality, again, over there, it seems to be more dominated in the unsecured space. So at least in terms of the commentary, what surprised positively is banks still continuing with their growth guidance. I don't think any of them have yet revised the growth guidance down, which was quite surprising because we thought that maybe if banks lending to NBFCs is coming off and RBI is slightly uncomfortable, we would see slightly lower target, which has not come through. And again, in terms of the margins, I think everyone mentioned like cost of funds has almost peaked, and now you should start to see the benefits in margin to flow through in the coming quarters. So these two were the positive guidance. And on the negative side, it was particularly on the asset quality front, wherein we saw the upward revision in the credit cost by a few of the NBFCs, and it might continue for a quarter or two. So that was on the negative side.
Got it. Well, I'd love to talk more. We haven't spoken about Zomato, Swiggy, and so much more. And then the new kids on the block as well. Not kids really, but we're out of time completely. So all of you, thank you so much for taking the time out and being with us today on the show. Really appreciate your time.
Thank you.
And viewers, thanks for tuning into this very special conversation with the Citi Think Tank.